Weekly and end-of-year S&P 500 market overview, central banks in action. As we approach the end of the year, it's important to note that this will be our last weekly market summary for 2024. We plan to return in January 2025 with new weekly market commentary. Rest assured, we will be monitoring the markets during this period and will update you daily if any emergencies arise through our short video commentary. All Things Money wishes all our viewers a Merry Christmas and a Happy New Year. S&P 500 Index, SPX, Long-Term Chart Analysis. The S&P 500 Index, SPX, continues to exhibit strength as we approach the end of the year. The SPX position in this strategy remains bullish. Aggressive traders should consider positions in the RIDEX Nova S&P 500 Fund RYNVX or other bullish S&P 500 index funds or ETFs such as SPY. As we move towards the new year, the odds favor higher highs, supported by strong market breadth and positive economic indicators. Weekly Market Statistics Summary. The S&P 500 index closed at 6,051, marking a decline of 0.6% for the week but an impressive increase of 26.9% for the year. As we look towards the upcoming week, key economic releases include PCE inflation and the Federal Open Market Committee (FOMC) meeting. In the past week, the Nasdaq set a new record, briefly crossing the 20,000 threshold. This year's stock market success can be credited to robust economic growth, increasing corporate earnings, controlled inflation, and the start of central bank easing. Despite a generally positive outlook, the slowing improvement in inflation during the fourth quarter introduces some uncertainty regarding future central bank actions. Here we will explore the implications of the latest U.S. CPI, Consumer Price Index, data for the Federal Reserve and examines recent activities of major central banks globally. November CPI, a mixed outcome with positive aspects. The November CPI was the last key data released before this week's Federal Reserve meeting, and there was some concern about a potential unexpected increase. However, the results met expectations, indicating that while inflation reduction progress has decelerated, a significant reversal is unlikely. Core consumer inflation, excluding volatile food and energy costs, rose by 0.3%, maintaining an annual rate of 3.3% for the third month in a row. This rate is half of the 6.6% peak in 2022, though still above the Federal Reserve's target. Acceleration in discretionary goods and services prices. The headline CPI rose to 2.7% year-over-year, marking the first consecutive annual increase in 8 months, partly driven by food and gasoline prices. Beyond these categories, prices for cars, furniture, hotels, and airfare increased more rapidly, reflecting strong consumer spending. Recent hurricanes also contributed to higher demand and prices for cars. While a slight inflation rise is anticipated over the next 2 months due to tougher year-over-year comparisons, this does not indicate a shift in the overall trend. Leading indicators, such as prices paid by manufacturers and service firms, suggest a persistence of current readings rather than a second wave of inflation. Positive developments in housing inflation. Shelter inflation has been a significant contributor to CPI gains this year. However, housing costs increased by 0.2%, registering the smallest monthly increase since January 2021. This helped the annual rate fall below 5% for the first time in over 2.5 years, raising hopes for a long-anticipated slowdown in housing inflation. Market-based measures for rents and home prices suggest that the disinflationary trend in shelter inflation has further potential. Given its 35% weight in the CPI, a housing cool-down could significantly ease overall services inflation. Inflation data supports December Fed rate cut, signals caution for 2025. In our assessment, last week's data will not deter the Fed from reducing its policy rate this week. There were no major surprises in the consumer or producer price indices, and the recent unemployment uptick aligns with policymakers' views that the labor market is no longer a source of inflation. The September Fed projections imply 2 additional cuts this year, one of which occurred in November. The bond market now anticipates a 95% chance of another quarter-point cut in December. Slower easing expected in 2025. As we enter 2025, the Fed is likely to slow its easing pace due to increased inflation uncertainty. Disinflation progress has decelerated, and potential changes in fiscal, trade, and immigration policies could complicate the Fed's efforts to reach a neutral rate, neither restrictive nor stimulative for the economy. We expect the Fed's updated December interest rate projections, the dot plot, may indicate a more gradual easing cycle, given stronger than expected growth and inflation since September. We anticipate 2 or 3 rate cuts in 2025, with the Fed funds rate settling in the 3.5% to 4% range by year-end. Other central banks accelerate toward neutral policy. Bank of Canada, BOC, takes the lead. Last week, the Bank of Canada reduced its policy rate by half a percentage point to 3.25%, the upper end of its 2.25% to 3.25% neutral rate estimate. Over the past 6 months, the bank has cut rates by 1.75%, faster and deeper than any other advanced economy. Unemployment has risen to a 2-year high of 6.8% as population growth outpaces job creation. Core inflation is within the BOC target range, and fourth-quarter economic growth has been weaker than expected, suggesting that policy no longer needs to be restrictive. However, with rates near neutral, policymakers indicate a more gradual pace for future cuts. European Central Bank, ECB, recognizes downside risks. The ECB also reduced rates last week, lowering them by a quarter point as expected. After 4 cuts in this cycle, the bank's policy rate has decreased by 1 percentage point to 3%. Unlike in the U.S., growth and inflation outlooks are being revised lower, and markets are starting to anticipate a significant rate-cutting cycle next year. Additionally, Switzerland's central bank surprised markets with a 0.5% rate cut, reducing its policy rate from 1% to 0.5%, marking the largest reduction in nearly a decade. U.S. dollar strength reflects diverging outlooks. With quicker rate cuts abroad, the gap between domestic and international interest rates boosts the dollar against other major currencies. This can make imported goods cheaper, helping to moderate U.S. inflation. International stocks tend to underperform during periods of a strengthening dollar, supporting our view that U.S. stocks are well positioned to continue leading. Entering a more uncertain phase, but the winning formula remains. Heading into 2025, the direction for interest rates is evidently downward, though the speed and depth of cuts remain uncertain. Unlike this year, where the Fed and other central banks implemented larger cuts, the pace will likely slow as they balance cooling but still above target inflation with a resilient economy and labor market. The Fed aims to avoid an economic slowdown by staying too long in restrictive territory, but there is no urgency to normalize policy. Investor confidence on the rise. Following a year defying economic slowdown expectations and the U.S. presidential election, investor and CEO confidence is surging. The NFIB Small Business Optimism Index saw its largest monthly increase in 30 years due to prospects for tax cuts and pro-growth policies. Capital spending delayed due to election uncertainty may materialize in 2025 and beyond, aiding manufacturing recovery and potentially sustaining strong economic momentum. However, with investor sentiment heating up, there is potential for periodic disappointments as expectations rise. Supportive backdrop. A shallower rate-cutting cycle suggests borrowing costs may remain elevated longer, limiting valuation increases. Yet, the winning formula's elements remain intact. Wages are rising faster than inflation, the economy continues to add jobs at a healthy rate, corporate profit growth is accelerating, and enthusiasm for innovation and artificial intelligence persists. Historically, the third year of a bull market tends to be more volatile, but conditions are favorable for balanced and well-diversified portfolios to deliver positive, albeit moderating, returns in 2025.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.